So today, I'm very, very happy to introduce our guest, David Fuller. David, congratulations on your Lifetime Achievement Award on behalf of the CMT Association.
Thank you.
And if we could lead into your approach, I mean, a lot of people will be keen to know, certainly, especially the new professional market experts out there, how you have been doing all you've been doing all these years. Mm-hmm. I've heard you mention it as over the years as the behavioral technical analysis
mm-hmm.
approach. Could you tell us some more on that?
Yes, I'd be delighted to do that because that was not the first approach that I actually was introduced to. When I went into the field, it's read a book on the subject, and I felt they were a bit mechanized. There's nothing against the authors or the publishing industry about this, but I felt it was a little detached from the reality of what the markets were all about, which is crowd psychology. Mm-hmm. And therefore, we are monitoring trends in the crowd. And that can be very volatile, as we know. Sometimes it will be very, very consistent. But that's reality in the marketplace, and it shows up very clearly on the charts. And so it quickly just occurred to me that back in 1970, that this was a behavioral approach rather than a mathematical approach overall. And that while fundamental analysis is certainly relevant and important, it's a fairly laborious process in terms of the number of companies, the number of markets that one can actually monitor. And so charts are a wonderful distillation in terms of crowd psychology, which markets are in form, which markets are out of form, how consistent is the trend. If the trend is consistent, then the trend is still in motion. And when the trend starts to lose its consistency, we have to be very alert to the possibilities of at least a reaction and quite possibly a significant correction if the trend has been very overextended. So that's the basic background to that behavioral approach.
Now, what's wonderful to actually have the opportunity in asking these questions is your sheer experience in the markets is vast enough to be looking back at some of the big cycles and to glean some experience as to what it was really like during those cycles, but then also how we can apply some of those lessons into the current cycle we're in. Mm-hmm. So in that experience, David, what has been your experience and how could we learn from that?
Well, you can't be, my current age is 76, you can't spend your whole adult life in the market and seeing all those cycles without learning something, at least in terms of the way markets actually perform. And that's so, experience, as in many fields, is invaluable.
And in terms of how the cycles change, because how would you describe, let's say, prior cycles to the current one when we get that gear shift between cycles?
Well, they didn't change all that much for a very, very long time. In other words, I've often said in some of my talks that if you took the time and the prices off charts, you wouldn't know whether something the chart was reflecting something that had happened 100 years ago or whether it was current live data. That's changing a little bit because of the mechanized trading that we actually get. Mm-hmm. It causes more very short-term intraday volatility, which is a little bit unnerving for traders, understandably so. But I think the big story that we should mention for your viewers is the big cycles of markets. And again, I remember when at the start of my career, or even before my career had actually started, I was aware that the stock markets had appreciated very strongly following the end of World War II, and that carried right on up into the early 1960s when I started to join, or mid-1960s when I joined the industry. And that was my naive conclusion was that, well, this is the way markets work and they're going to go on doing just that. But those big secular, as in long-term, bull markets, such as that post-World War II, they inevitably fulfill their lengthy medium-term potential, and we go into a choppy, ranging valuation contraction phase, such as we saw really from the mid-60s right on through to 1982, which is a very, very different environment, much more difficult to actually deal with. Some savage bear markets in there too, in particular, were extremely savage. But those valuation contraction cycles then set the markets up for another major bull run, and that started around 1982 and carried right on up into 2000. And then again, you see with these long cycles that became overextended, a little bit euphoric. We had the big tech boom before tech really made all that much money, but people saw or believed in the future potential of tech. That was followed by another secular, ranging, bearish phase. Now we're in the early stages, the early foothills of another secular move to the upside. So these take several decades, these long phases of big move to the upside, a couple of decades at least of reaction and consolidation before the next big upward lift. But we are now currently, I'm fairly convinced we're in another secular bull market, which of course is led by technology.
Okay, and on that point, David, all these cycles, bull or bear, but in this case, are driven by themes. And you've long had key themes for each of these cycles. What are the key ones behind the one that we're currently transitioning into?
Well, the best way to answer that, or the best way for anybody to answer that, is look at the action. What's actually leading? We don't tell the market what it should be doing, what should be leading, but look at the actual evidence. And it's dominated by technology. Not all technology, but the big technology players are way outperforming most other sectors. And that's understandable because we are currently in an accelerated rate. I've been saying this for years. We're in an accelerated rate of technological innovation. And if you think back 10 or 15 years and the dramatic changes that have occurred, or if I think back to the beginning of my career, it was Dickensian in comparison to what we actually see today. And my belief is that over the next 10 to 20 years, that we will see technological advances that actually exceed most people's imaginations and expectations, and that will have a profound influence on economic growth, on stock market performance overall. It's not all positive. It's very disruptive for certain industries, of course, but that's part of the whole evolution of the market cycles.